Hi traders, Richard here, and in this video I'm going to be talking about dynamic money management. What it is, I'm also going to be showing you some of the techniques I personally use to trade the markets, and hopefully all of this can help you guys pass your next prop trading firm challenge. All right, so what do I mean by dynamic money management? Well, simply put, before I get onto the chart here, it's basically rather than placing, let's say, static take profit orders. Quite often hear that if you risk one, you should at least aim for a 1 to 2 risk reward ratio. For risking one, you want to make double in profit or three in profit or whatever that ratio might be. Now, using dynamic or static targets, at which is obviously judged by distance of how far your entry is from a stop loss, and then multiplying that to the upside, downside, whatever direction you're trading. Because it is static, there's obviously no guarantee in the market that price is actually gonna reach that, assuming that the trade is in profit and price is moving in your intended direction. So I'm sure a lot of you have all been in situations where you place a dynamic, not a dynamic, a static take profit level, and price doesn't reach it. It gets very close to it, reverses, and you end up with a loss or a break even. Right, so that happens to the best of us. So this techniques actually sort of developed to mitigate or avoid those type of situations. But there are also a few pros and cons about it as well, which I'll definitely talk about in just a bit. Right, I'm just going to explain things here on the Nasdaq. I've got a chart open in 5 minutes, could be any time frame, and I am cherry picking two bullish type of moves to the upside, one over here and one over here. So this is not real trading environments, but for the sake of explaining what dynamic money management is, I think this is a really good example during this occurrence when we had two little moves to the upside here. All right, so the first thing I want to do is, let's say, assume, again, this is cherry picking some moves here, that you anticipated some sort of bounce to the upside. Now, whether this is using your indicators, whatever your strategy is, really that's up to you. But again, just for the sake of explanation, let's say, for example, you got in here, right? You then go place a stop, let's say at 90 pips or so, all right? Just plus minus. Now, double that, for example, if you aim for 1 to 2 risk ratio, would be 90 times 2, right? Which is 180. So if I have to go and grab my range tool again to the upside, 190 ticks would be, again, roughly around about there, right? So price very, very easily in this situation reached 190 ticks or double what you initially risked on the trade, assuming that you got in really close to the bottom. All right. But what happens afterwards also to a lot of traders is as soon as you get out, the market keeps going and you could have walked away with some more profit. And this is where dynamic money management will come in just a second, rather than having a static take profit level. Let's use this little bounce up to the upside here. Again, I'm just using bullish scenarios as if you would have gone long. And let's say here, for example, also very close to the bottom, you got in there with, I don't know, let's just make it 100 ticks, 100 pips stop loss. And again, you like trading with a 1 to 2 ratio, then to the upside, it'll be doubled it, which is 200 pips. Now, in this situation, if you go and scroll to the right, price did not reach that secondary target. Now, if you moved your stop loss to break even, then you probably just walked away with nothing. But the thing is with this, that you did leave some money on the table, which can be very, very, very frustrating. Right, so to quickly show you the technique that I personally like using when it comes to dynamic money management and open positions, is that I like to trade with equal amounts of lots, for example. Again, this is just my strategy. You can completely do whatever you want, but I think for sake of explanation, this works really well for me, and maybe something you can look into as well. Now, let's say I'm going to draw in a few lines here. Let's say that green line there represents my entry level. I'm going to do the same over here. Just bear with me. And let's say this one was your stop loss level. Make that red for stop loss. Let's do the same on this side. Red for stop loss over there. And let's draw in that static 1-to-2 ratio on both these scenarios. One there and then one there. All right. Now, what I want to do quickly here is let's just get rid of these range measurement tools so I can explain properly what it is I personally like to do. Right, this is again assuming the trade went in your direction, assuming you got into a trade pretty close to a reversal, whatever the case might be. It could be a trade, breakout trade. In the end, it doesn't really matter. But for sake of explanation, we know that this trade, obviously, in hindsight, would have worked out really nicely. But you gave up quite a substantial move afterwards if price reached your 1-to-2. In this case, it would have if you got in around about the bottom of that reversal, right? So what I typically like to do is, as I mentioned, trade with, let's say, 6 contracts, 4 contracts, or you guys can call it lots, whatever the case with me. Let's say you're trading with 4 lots, for example. Right. Again, this depends on your account size and all those sort of things. So this is one of the things I won't say it's a con about the strategy, what I'm going to show you now, but it is definitely consideration that you need to be aware of. So that would be the distance of your original stop loss, right? So what I like to do is if I were to trade, for example, with 4 lots, then at a 1-to-1, I would take off half of my position, right? And rather than have a dynamic target, I'll get rid of that. So I'll just have one target, but taking half my position off. So if I traded here, let me just get my, where is that? My text tool. Let's say I went 4 buy long, right at the entry level. Then I would take 2 off at, let's say 2 off at, let's call it like this, 1-to-1 ratio. All right. So at this stage, as price reaches that, then I would then have only 2 contracts remaining in the market, or 2 lots, depending on what you trade. Pips, lots, contracts, whatever floats your boat. The rest of the contracts, then what I will do is basically move my stop loss, not to break even, because this is also another issue that a lot of traders experience. They either move their stop losses to break even too quickly and they get stopped out, and just soon directly afterwards Murphy's law, price moves in your direction. So I would then, on the remaining 2 contracts, reduce my initial stop loss distance by half. Now, what would happen here? Let's say after price reached that 1-to-1, I only have 2 contracts left, and it reverses lower and takes me out after also reduced my remaining stop loss distance, then at least I'll be walking away with a little bit of profit, right? In this case, that didn't happen, and we had a nice strong move back to the upside. But I try to avoid not to move my stop too soon, if that makes sense. Now, I believe in the initial stop loss distance, that was 85 ticks or something like that, right? So what I like to do is multiply that by 1.5, and that'll be about 127. Let's call it 130 ticks. So once price then moves 130 ticks in your favor, 1.5 times, which is not too far from that initial move. Let's just pull in another line there to show you what I mean. Get rid of these others. You can see what's going on there. Then as soon as price reaches that 1-to-5 level, I'll then immediately go to break even. Sometimes the candle can just touch it, that's fine. Or if you want to have it in pip or one tick away from the candle, then so be it. Then my stop loss would go to break even. Most cases a little bit in my favor, a few pips in my favor. And then what I'll do is this is where the dynamic side of things come in. If the market continues higher, I then like to trail my stop below a candle that makes a new high. And now the price has actually got to close, not the wick, close above the previous candle's high. So you can see this red candle over here, for example, does wick above the previous candle but doesn't close above it. So here we have another situation where price, for example, made another high. And in some cases, I know guys that trailed basically two candles. In this case, I'm just using a 5 minute. You can actually go to a smaller time frame if you wanted to. And basically, all I'm really trying to do is lock in as much profit as possible. Now, if you were to follow this technique, you would actually, I believe I've done this before shooting this video, you would have gotten out somewhere around about here. Right after price did this, moved a little bit sideways. So this also requires a lot of patience. I won't call that a con in trading. It's just something that you definitely need to be aware of. A lot of traders can get quite impatient. It happens to the best of us. But in any case, the idea here is that using a dynamic trailing stop, for example, behind price as it moves your direction, you're trying to milk the market out as much profit as it possibly can give you before getting stopped out. In this case, very close to that actual high before price removed lower. All right, so let's talk about the same thing here before we finish off this video. And let's talk about that second scenario where price did not reach that 1 to 2 level. All right, so here, let me just get my rectangle out. Let's assume again that was where you would have placed your stop. Again, green line represents the entry level and the red one stop loss. If price reached a 1 to 1 level, right over there, which it did, then I would have taken half of my position off. And then the remaining 2 that's in the market, I will then move my stop loss to midway. Right? In this case, 1 to 5. I don't know if price actually reached the 1 to 5. I can't remember what the actual distance was there. No, I think it was 90 ticks. So 90 ticks or pips times 1.5 was 135 ticks. Yeah, right about there. In this scenario, price would have just reached that 135. It actually went as high as 140, I would say. And if it did that, I would have then moved my stop loss to break even a pip in my favor and then start trailing my stop loss below or the actual candle as it makes a new high, or you can keep it behind, depending on how volatile the markets are. You can potentially try to trail it 2 candles behind the candle that's actually pushing to new highs. Right, but let's say, for example, you did that and you did this as that one makes a new high. In this scenario, you actually got out very near the top once again. Now, this won't always happen. You've got to be very aware of that. But what did happen here was is that you reduced your risk as soon as possible on the remaining contracts that you had in the market. You reduced that risk as also, even if the market moved against you, did not reach your target or you didn't get out, at least you booked that 1 to 1. The market can do whatever it wants to. And that gives you quite a bit of, I would say, a peace of mind is probably the right word to use here. That, the market can do whatever it wants to. At least I will walk away with a little bit of profit, if it makes sense. All right? Or very close to break even or slightly above break even. But if the mark then does go in my way, that I don't move my stop too quick, so then I get stopped out prematurely. But I also give the market as much space as possible to do its thing. And if I do get those runners, I can then use a dynamic trailing stop method like I'm showing you here. And again, it's just a method that I like using, that you can use to trail as close as possible, or maybe a few candles behind it. Again, completely up to you. But at least what it does is it helps you milk the market out as much profit as possible. Now, the other con about this, maybe it's not a con again, but consideration is probably a better word, is that once you start using these types of market management techniques, I do find that it's very important that you stay consistent with that. You don't one day have a static target, and the next day you're going to use a dynamic trailing method. And then you just jump around between, different methods all the time. Then you're going to have inconsistent results. I typically like this method because it's quite a relaxing way. It keeps me disciplined. I don't get stopped out quite often too prematurely. And when you do get those lovely runners, then you can really, really milk as much profit out of a move as you possibly can. Right, so that was dynamic management techniques, and I've shown you one that I personally like using. Hope you enjoy that, and hopefully this information can help you pass your next prop trading challenge. Thank you very much for watching. I'll see you next one. Take care, and goodbye.